Welcome to the world of smart investing. Ever wondered if a stock is undervalued or overpriced? Meet the price-to-book ratio. The formula is simple. Take the stock price, divide it by the book value per share. The book value? Think of it as the company's assets minus its debts. Here's an example. A company has $100 million in assets, $75 million in liabilities. The book value is $25 million. With 10 million shares outstanding, the book value per share is 2 to 50. If the stock price is $5, the PB ratio is 2.0. This means the market is valuing the company at twice its book value. A PB under 1, that's a goldmine for value investors. Over 3, it might signal growth or a bubble. Context and industry norms make all the difference. Every industry has its quirks. Tech stocks often boast higher PB ratios while manufacturing stays grounded. Always compare within the same sector. High PB but low returns? That's a red flag. Dig deeper to uncover what's really driving the valuation. Investing is all about the details. The PB ratio is more than just numbers. It's a tool for smarter, sharper investing. Use it alongside other ratios like the PE and ROE to get a broader view of a company's financial health and make more informed decisions. Want to dive deeper into ratios and investing? Subscribe now and stay tuned for more learning to sharpen your financial skills.